Hello and welcome to Rates Live in, well, it's August, isn't it?
Sure is.
Yeah, it always trips me up trying to count when these decisions come round. This is going to be a critical one, very much live, Nadine, and you only have to look at what's happened in the past couple of days. Lots to consider at the moment.
Well, you know, I went back onto the RBA's website and just happened to look at the first line of Michelle Bullock's media conference. Of course, she welcomed people, and then she said, to be honest, we're at a really complex part of the cycle at the moment. And I dare say, Andrew, it's become more complicated.
Yeah, absolutely. You only have to look at what triggered that mass sell-off in risk assets, with obviously concerns about US economic growth, earnings, the unwinding of that carry trade with the yen, geopolitical tensions. There is much to consider.
There is. Okay, so we have a great program lined up for you. As per usual, we've got our guest host here, I'd say, David Flanagan from Curve Securities, here with us at our Barangaroo studios. We're also being joined by Annika Thompson, who is Chief Economist at Creditor Watch, and Stephen Dooley from Convera. Annika, I might start with you just for a view as to where your eye will be going to
we're 5 seconds away. Let's actually...
Too excited.
Sorry, Annika.
You may look at your computers.
Here we go. It has... Whoa. There we go. Unchanged, as expected, and just trying to get across these numbers that are throwing us. Well,
because they've got their forecasts, of course, coming out as well.
With the statement on monetary policy. So it is...
The board saying it will not rule anything in or out, so that is a familiar language now, though pointing out that inflation does remain above target and is proving persistent, saying the outlook remains highly uncertain as it leaves the cash rate at 4.35%. Still, Andrew, I mean, I don't think we expected any change in this rhetoric, saying that returning inflation to target is the priority.
Yeah, that's right. Remains resolute in its determination to return inflation to target. So no change in that language, despite obviously what we've heard over the past couple of days. You have to look at what's going on in the States at the moment.
So I just made a note before we came in here as to where the market was sitting. It was at 6,776. It's just risen by 10 points or so since we have had the release of this statement. And while our guests give it a bit of a read, looking at the Aussie dollar has risen. So going into the statement up around 64.92, and it's currently at 65. So look, obviously nothing I guess we can talk about without mentioning sort of the global context as to where we sit right now. But David Flanagan, perhaps we'll start with you. Was there any big change in that very important final para?
Doesn't look to be a huge amount of change. I mean, there's a lot of volatility in markets, but as far as the RBA is sort of concerned, markets aren't their mandate. Obviously, they're focusing on inflation and on unemployment, and they do put a sizable amount of this month's text into the most recent national accounts once again, but also the inflation update, highlighting that yes, while it's moving towards where they expect it was broadly in line with their forecast. They do note that there are some areas within the inflation data that are showing the inflation is proving persistent. So, they're playing a pretty straight bat here. That narrow path still firmly, or the tightrope walk more so, is still firmly in play. So unless there's some sort of really big dislocation from this market's volatility, it's hard to see to make your knee-jerk reaction at this stage.
Annika, let's bring you in. How would you frame the language you're hearing at the moment? Is this still fairly hawkish? It mentions, second last part there, inflation in underlying terms remains too high. Latest projections show that it will be some time yet before inflation is sustainably in the target range.
Yeah, I just got to the brief, obviously not able to look at the full forecast, but they have pushed back their date to be back in the target band to late 2025. So I think it's only a minor pushback. So they are acknowledging that inflation is falling slightly slower than they'd hoped. But I don't think it's anything, it's nothing too dramatic. I would still say that this, bodes for a cut to the cash rate early next year. I don't subscribe to the view that we're going to be later this year based on this very, very early read of their forecast. But there hasn't really been much movements that I can see thus far between May and today's forecast. They do make mention that there is a risk of a noticeable deterioration in the labour market due to very poor consumption and household consumption. So again, I think they'll be watching that labour market shift very closely through the second half of this year.
Stephen, let's bring you in, and obviously we did see the Aussie move higher. So what's that telling you? And I guess given that language that we're hearing from the bank.
Yeah, I think the Australian dollar is just moderately higher here. It's probably up about 10 pips since the announcement, so only moderately higher. But I think what's most interesting in the statement is it looks like an additional line saying that policy will need to be sufficiently restrictive until the board is confident that inflation is moving sustainably towards the target range. So I think that suggests that maybe a rate hike is now off the table, but it does indicate that the RBA might still be one of the central banks that lags other central banks to start cutting rates. So I think this ties into that view that regardless of the action that we've seen across financial markets over the last couple of weeks, hasn't really moved the needle for the RBA. And for now, their focus is really on the domestic story, the fact that inflation is still too high, according to where the RBA wants that. And I think that's what the statement is telling us today, that maybe there's no rate hikes, but for now, rates will need to stay where they are until we get more evidence that inflation is lower.
So just spent a moment sort of reading the last paragraph. Last month it was 2 paragraphs. This month it's 3. We were talking a lot yesterday about the fact that the RBA is unlikely to make reference to the turmoil that we've seen in financial markets over the past couple of sessions, but they have changed that final paragraph just slightly, saying that, of course, paying close attention to the developments in the global economy and financial markets. The "and financial markets" is actually a new addition. Trends in domestic demand and the outlook for inflation and the labour market. But, really, what they are saying here is that they will continue to be very data dependent. But I do, David, think it's interesting that they've put in global economy and financial markets in there.
Yeah. Obviously, they do take into account financial market
no
moves
kidding.
anyway, but yeah, ramming home that those things will play a role. But,
Yeah.
I've just had a bit of a deep dive into the forecast data and the S&P, because obviously we get that this month as well, and some pretty interesting things. Slight downward revision to growth for the remainder of this year, and then an uplift in growth through 25 and 26, only slightly. Unemployment forecast been lifted 0.1% across all terms compared to the previous statement. Big moves in headline inflation, obviously owing to a lot of those temporary measures. So headline inflation now expected to be down significantly towards the target band by the end of this year. But obviously as those unwind, they've noted that headline inflation will jump back up at year end 2025. But trim mean inflation has been slightly revised a little bit, but still down within the target band by the end of next year, which was what they were previously expecting. So a bit of noise in the headline number with those temporary measures, but as far as the underlying trim mean inflation, that looks to be heading where they want it to go.
And they're saying in this statement that as represented by the trimmed mean, CPI was up by 3.9%. So sort of showing that the underlying inflation, it says, has now been above the midpoint. So talking about that underlying and trimmed inflation.
Also interesting, once again, productivity proving to be a sore point for the Australian economy. ANIC, they're saying that wages growth appears to have peaked, but is still above the level that can be sustained given the trend in productivity growth.
Yeah, that's right. I mean, I think they still want to see a couple more data points to really be certain that wages growth is under control. And certainly we need some better data on productivity, acknowledging the fact that it's a very difficult thing to measure these days. I think the old ways of measuring productivity don't necessarily stack up in a modern economy. So it is a difficult thing for them to measure, but I think it's inarguable that productivity growth has to improve over the next couple of years if we're going to keep inflation under control in the medium to long term.
It's interesting, though, that not hitting 2.5% over the forecast until December 2026. Like, that's quite a long time away, Annika. A lot can happen between now and then.
Yeah, we're also going to remember that, inflation's barely been within the band, over the last, 10 to 15 years. It's mostly been a bit below it in pre-COVID times. So I think it's a reasonable, as long as it's within that band, I think that is a fairly reasonable target and a fairly reasonable forecast to be making. I mean, having had to make these forecasts myself and all sorts of measures, forecasting anything beyond a year, especially with geopolitical tensions as they are, we've got the US election coming up at the end of this year, it's a very difficult prospect. But I think their sustainable approach to that midpoint feels about right to me.
Might just pick up, David, I noticed you're drilling a little further into some of those forecasts there. So what have you picked up in terms of inflation?
One thing to always look at is what the RBA's assumptions are to these forecasts, because obviously we look at where, they upgrade this by a little bit, downgrade this by a little bit. So last quarter in the S&P, it's always the first point under the forecast. It says the forecast condition the path to the cash rate, in line with financial market pricing. So last quarter they assumed it to be on hold until the middle of 2025 at 435, and then drop to 3.8% by the middle of 2026. Fast forward to this quarter, they're now expected to be on hold till early 2025 and then drop to 3.3% by the end of 2026. So their forecasts have factored in sort of 100 points of easing between the first quarter of 2025 and the end of 2026. So, you can argue then, based on their forecast and what that assumption is, if things run too hot with inflation, then that may mean that they hold it for longer. If they get greater progress in their current forecast, then that could pull it forward. So you've got to understand not just what the forecasts are telling us, but what's the assumptions in those to then get that full picture of what the RBA might do in the circumstances that they face. I thought that's quite interesting that they've increased the amount of easing twofold, from 50 points to 100 points across that horizon, even though we've only seen very little tweaks in the numbers other than the one-off inflation measures that are in the headline inflation forecast.
So what's bond market pricing doing right now?
So interesting, that's mostly been driven, hasn't really changed, it's mostly been driven from offshore. If anything, a bit of a rebound in yields off the back of that, but looking at what the market's got priced in, they're probably increased their expectations for easing rather than reduce them post-statement. So maybe that's just an unwinding of the risk of a rate hike, even though they say they've got to be vigilant. It just could be the market's now basically taking a prospect of a hike out, which means that the other side's a bit more aggressive.
And Stephen, of course, we did see that reference to what's going on in financial markets, certainly over the past couple of days. But are there implications for Australia longer term, given what we're seeing, particularly with the unwinding of that carry trade with the yen that appears to have been certainly one of the catalysts for this massive sell-off following that the Bank of Japan, of course, lifting rates?
Yeah, Andrew, there's another mention or reference to the volatility in financial markets as well, about halfway down. So the RBA really is on top of this in the statement. Certainly for the Aussie dollar, it tends to be one of the currencies that's most sensitive to any kind of sell-off across markets. And look, the last month or so, really clear that there's been three big factors that have driven this sell-off across markets. First of all, that slowing economic data out of the States. Second of all, those weaker earnings results that we got, particularly from the technology firms like Tesla, Amazon, and Intel. And then, of course, the Bank of Japan raising rates last week as well. So a case of three factors really driving that catalyst. And generally, when you see such a significant turnaround in financial markets, and the dollar Japanese yen and the NASDAQ both almost exactly highly correlated and moving in the same line as each other, it really does appear the last month has been a clear reversal in that risk sentiment, and such a substantial move, what we sometimes call an impulse move, very often is the sign of something significant turning. So, for now, we'd be concerned that this sets up more volatility into the back half of this year. We'd be particularly concerned going into the US presidential election with that kind of uncertainty. And in that kind of condition, the Aussie dollar tends to underperform. That said, the Aussie's actually done a little bit better than you would have expected in these last couple of weeks. And that's mainly because the US dollar's been underperforming so much as well. So the US dollar clearly really underperforming versus the Japanese yen, but also versus the Chinese yuan, the Singapore dollar, the euro. So it's quite rare that you see the kind of sell-off we've seen across markets, particularly equity markets, and for the US dollar to underperform as well. So that's provided a bit of comfort for the Aussie dollar, but that might not last, and the Aussie dollar probably quite vulnerable to any further volatility across markets.
Yeah, it wasn't very volatile. I mean, up by about 0.25% in the immediate wake of this decision, but it had eased, going into it. So sort of right back to where it was earlier in the session. So is there anything to read from that, or, it sort of says what it is on the tin?
No, I think it does say that over the medium term that the RBA probably is going to be one of the last central banks to cut interest rates, and that should be supportive of the Aussie dollar as we go into the back half of the year, excluding the fact that we will see some weakness across markets going into the US presidential election. But in the very short term, the Aussie dollar has just been driven by that volatility we're seeing in other markets. Of course, the Nikkei up 10% as we speak now, the dollar yen recovering as well. So, markets are highly correlated. They often are during these times of big market-wide sell-offs. And so for now, yes, the Aussie's up a bit after the announcement, but for the next couple of days, we're probably more likely to be driven by the broader risk appetite across markets. Over the medium term, this should be supportive for the Aussie dollar because it does signal the RBA probably going to lag other central banks.
So we are, of course, hearing from the Treasurer, Andrew, weighing in, saying that today's welcome decision to keep interest rates on hold recognises that Australians are under pressure.
Well, he needs to say that, doesn't he?
Yeah.
He's got to keep the Australian public on side.
On that, I thought it might be worthwhile to talk to Annika about what she's seeing at the coalface and the data coming through Creditor Watch.
Yep.
Because if we do, keep rates on hold for longer, I mean, how close to the wall are some of these small to medium-sized enterprises?
Yeah, I mean, I think every time we've spoken, I've spoken of a declining performance in businesses that feed into our data set. Unfortunately, I guess in the last 2 months, there's been a noticeable step down. So the average value of invoices dropped by a really big amount last month. And I just got, July's data yesterday, and it's dropped it again. So usually you'd see a drop in June and then a slight step up, but it's bucking the trend. It's staying well down on long-term averages. So we can see that at least small and medium enterprises, which is what our data mostly follows, are seeing significantly reduced volumes. And we already know that because business investment has fallen, and forward orders, in NAB's surveys and other bank surveys, forward orders are all declining. But we're actually, seeing that really come through in the data. And then other sort of stress measures as well. Trade payment defaults are again rising this month. So I think we've got another record month of trade payment defaults. So, the cash flow pressures that we've been seeing for the first half of the year, they're certainly not changing, and they appear to be getting worse. And just looking at the forecasts and the updated forecasts and the monetary policy statement, look, the RBA they're suggesting that by the middle of next year, there's some recovery in business investment. So business investment at 0.1% for December 2024, a fairly big jump up to 2.2 in June 2025, which suggests to me, as well as unemployment staying quite flat, 4.3 by the end of this year to 4.4 by June 2025, that to me means, at least one cash rate cut to the cash rate banked in for the first half of next year. Otherwise, these outputs in business investment and unemployment don't really make sense. So I guess businesses and small businesses and households can get some comfort from that, but the RBA is certainly expecting a recovery in economic conditions by next year, but I can only see a cut to the cash rate driving that, to be honest.
Yeah, in fact, Annika, they go on just as far as household consumption. They're seeing that pick up too, with public demand supporting that, saying the growth in GDP expected to increase further into 2025. stronger than previously forecast, given public spending. Is that sort of align with what you're seeing at the moment, and given obviously what governments are doing?
Yeah, so public demand staying, fairly flat, 4.3 end of this year, 4.1 middle of next year, then a big drop down. So what they're suggesting is by the second half of next year, growth in private enterprise will overtake growth in public spending, which is a pretty bold assumption to be making. Obviously, the state governments have to come on board and start reducing some of their expenditure, which, as we know, is a tougher ask than getting the feds to do it. So I do think that assumption is pretty bold, but they need public expenditure to fall to keep inflation, particularly construction side inflation, will keep getting that down, especially if dwelling investment's going to improve at all. So yeah, they're basically seeing a swap between businesses driving the economy by the middle of next year versus public expenditure driving it at the moment.
Annika, what in your view is the next really critical data point for this very data-dependent central bank? I mean, I know, really, there's not a lot coming through in the next little while. I guess jobs data, mid-August would be the next big one.
Yeah, obviously, jobs comes out every month. I think they've got enough data they need on consumption. So, retail trade and the quarterly volumes data came out last week on the same day as CPI. So Australians have been spending less or in volume terms per capita for 8 quarters in a row now. So I think they'll be very confident now with that data that they've killed not discretionary spending or demand in discretionary spending. They've absolutely put the nail in the coffin there. And households have mostly, with probably the exception of some of the older households that have no debt and savings in the bank, but most households with debt or who rent have gone through all of their savings. So yeah, I think it would be unemployment. I still think that will just tick up ever so slowly. I agree with their forecast. It will just keep nudging up by 0.1% every couple of months until we get to that mid 4%, unless something quite dramatic happens overseas and businesses, particularly US domiciled businesses, start to get quite nervous and might lay off staff in bigger numbers. But yeah, it will really be jobs growth data, and I do hope they keep an eye on insolvency data and the performance of businesses, because certainly what we're seeing is that it's very, very tough out there for small businesses.
David, what do you see as the risks to the economy going forward? I mean, it's the statement on monetary policy is saying the labour market is expected to ease further over the next year before stabilising at a level closer to full employment estimates. I mean, we saw what happened in the States with those jobs numbers, another catalyst for that market panic, essentially, that we've seen over the past couple of days. Are there any risks here, particularly as far as the employment numbers are concerned?
The labour market will probably be the one thing that gives the RBA the trigger to move. I know they say inflation, getting it under control, is all the focus, but there's a little statement in here about the board's decision in this SOMP just before those forecasts, and it says today's decision balances the dual objectives of monetary policy. And then it says it balances the risks of further setbacks to the time it takes to return inflation to the target, with risk there could be more significant easing in the labour market conditions than forecast. So if you put your RBA hat on and you're having to make this decision and you think about, okay, what might be my triggers? I need to make sure inflation's under control, but I can't let unemployment, because trying to then push unemployment back down, you're going to have to do a hell of a lot more. So I'm looking to do everything I can on inflation without harming unemployment. But if unemployment shows any signs that it's going to accelerate up beyond what they're forecasting, that 4.3, 4.4, 4.5, you're getting on the front foot, and that will give you the room with inflation, I would say, if unemployment's rising, to then start easing earlier. But I think they're going to look at this and go, okay, well, I'm going to hang where I am as long as I can, because if unemployment's not rising, I've got capacity to just keep my foot on inflation. But if unemployment starts to get, the market gets dislocated, we start to see, these big layoff decisions and a big significant turn in the data on a trend base. Obviously, month-to-month employment's a crazy number to try and predict these days. If we start to see that trend employment growth fail, and Annika's probably got as better sign on any of this than we do in terms of the employment underlying in those small to medium enterprises. If we start to see a significant drop off in employment on the back of the lower invoices and the lower business turnover, then that's going to be the RBA sign to go, okay, we're moving from, we could do either to we are ready to go as soon as that gets a bit dislocated, because they will not tolerate unemployment getting up north of 5 this time around. Now they've made such good progress on it.
Of course, we keep our eye on headlines and other media outlets and X and what all the punters are saying as well. In your view, like if you were rocking up to this media conference that takes place in just about 40 minutes, which we'll bring to you live, is it hawkish, do you think? She'll sound hawkish? Do you think she sounds dovish? Like, what have we learned from this statement and the SOMP today as well?
I like the old alert but not alarmed. I think that comes from the Stevens era, alert but not alarmed. I think they're very alert to both upside and downside risk. Obviously at the moment we're looking at downside risk because of this volatility in markets. It's got everyone on edge. Obviously, you can have dislocation in financial markets lead to the recession rather than the recession triggering where markets should be fair value. So it can be self-fulfilling prophecy in that way. So they'll be alert to the fallout of the wealth effect of markets and the perception of I think I've had more clients talk about their super balance than anything else in the last 24 hours. So that has a real world effect when you think from a consumer, my super balance is down 10%. That might mean that marginal purchase gets withheld. So there can be real world effects to what's happening in global markets and in the headlines. So that could be a self-fulfilling thing where the economy does have event risk, and then that transpires into that straw that breaks the camel's back, and everything starts to move in the downside direction.
All right, well, time then, as we round out the show for predictions. All right, David, starting with you then. Does the RBA stay on hold? Next move is a cut. If so, the trigger and when?
Next move will be a cut, not a hike. Not next meeting, but next move will be a cut.
Yeah.
I've got to think, as much as I'd like to think it's sooner rather than later, I've got to think they're going to hold on as long as they can. So absent any dislocation, I'd say we're looking at February. I think they'll try and ride out the year as long as they can and make sure inflation is well and truly under control. If things get dislocated, well, then they're another story. But I'd say February is the earliest we're looking at there.
All right. Stephen, what are your thoughts?
Yeah, there's only 3 more meetings left with this new timetable, so it's hard to stay on top of it. But I think they probably will go in December. I think that we're probably going to see quite a significant slowdown in the global economy over the next 3 or 4 months. So I think by the time that we get to December, I think that most central banks will be looking to cut.
Annika, any final thoughts either on that or something that we should have in our minds as we prepare ourselves to hear from the Reserve Bank Governor at 3:30?
Yeah, look, I still think a February cut's most likely, but I would say when we're looking at that employment data, which I think we all agree is the data set that the RBA will focus on, breaking out public sector employment and private sector, I think that's what they'll be doing for the next 6 months. They know public sector employment's been really strong, but looking at that private sector, once private businesses stop hiring, that could be another trigger because that sort of gets a little bit hidden in the unemployment rate. But they'll certainly be watching that trend. So that's one for everyone to watch as well.
Yeah, thank you. Look, quick check on the markets just before we go. We've got the S&P ASX 200 at 7,676, bang on where we were coming into this.
Well,
Andrew.
and the Aussie dollar similarly hasn't really moved after all that, has it? So back to where it started.
Look, a huge thank you to our guests, Stephen Dooley from Convera, Annika Thompson from Creditor Watch, and David Flanagan from Curve Securities. Really appreciate your time. As always, guys, thanks for joining us for Rates Live.
All right, and stay with us, of course. We will bring you Michelle Bullock's press conference live. Hello and welcome to The Close on this Tuesday. I'm Andrew Gagan. Dragan, join us as we count down to the close following that decision from the Reserve Bank. Let's see what's going on equity-wise, and not a lot of movement there, certainly in the midst of that decision at 2:30 there. But overall we can see that the market is maintaining its positive gains for the day, up over 0.4%, following of course some very heavy falls over the past couple of sessions. So in somewhat of a recovery mode. And just to reiterate what we heard from the Reserve Bank following its decision to leave rates on hold as expected at 4.35%, saying, we've heard this the previous couple of statements, the economic outlook remaining uncertain, and inflation in underlying terms, it says, remaining too high. The latest projections showing that sometime yet before inflation is sustainably in the target range. So interesting to see whether the market is seeing that as perhaps more hawkish than anticipated or not. Looking at obviously that chart, maybe not. Also the Aussie dollar. Well, let's get some analysis of what we're seeing with the currencies. Matt Richardson is joining us from OFX. Matt, good to see you.
Hello.
So what did we see in the Aussie? It sort of bounced higher, then came back, and after all that, no real move.
Yeah, exactly. Look, given the fireworks that we've seen across FX markets through the last 48 hours of trade starting on Friday, really not much to write home about in response to that RBA policy update. And I think that really just reflects that the market had priced in the fact that the RBA would leave rates on hold and that we weren't really going to get any guidance as to whether the RBA was leaning towards a hike or a cut as that next move. They've clearly maintained that their inflation remains well above the target range, and that is the key directive in getting inflation back into that 2 to 3% target band, and that they're not ruling out a hike at this stage, while most of the market is expecting that next move to be a cut. Maybe we do get some more guidance from that press statement and the commentary with the RBA governor in just a few minutes' time, but at this stage, pretty little reaction for the AUD in the aftermath of that, given few surprises so far in that statement and the decision.
Yeah, so given what we've heard from the statement, likely that those rates are going to remain on hold for an extended period. That being the case, and given what we're seeing with the RBA's global peers, they are beginning, of course, the easing process. How supportive is that going to be for the Aussie?
Well, hopefully, after we get through this clear period of negative risk sentiment that we're running through at the moment, that will add some support to the Australian dollar. And I mean, just at the start of July, we were looking at the Australian dollar breaching sort of 68 US cents and potentially moving towards 70 at the end of the year. And we still maintain that that is fair value for the AUD in a positive risk environment. But those fears of recession in the US, obviously US political uncertainty as well, and some softer data out of China, as well as policy updates in terms of fiscal measures that haven't met the market's mark in terms of rebooting that Chinese economic growth engine, coupled with commodity price falls, have all sort of conspired to send the AUD lower. And of course, the sell-off of the Aussie dollar with Bank of Japan moves as well, and the introduction of tightening monetary policy there. The AUD has really been, I guess, the whipping boy for that carry trade being rewound in terms of yen positions as well. So the yen appreciation has really been one of the factors driving the AUD lower over the last couple of weeks.
Well, not just for the AUD, you take a look at that move by the Bank of Japan and the subsequent appreciation of the yen, given they lifted rates, and that appears to be one of the key catalysts for the sell-off that we've seen over the past couple of days, where that carry trade with the US dollar has unwound.
Absolutely, yeah, and that was part of the panic yesterday as well, where we saw the AUD plunge through 64 cents, touch lows around 63.80 at one point. I think it even looked at like it was moving towards sort of 63.50 before starting that recovery on the back of that ISM services data and an easing in those negative sentiment tensions, particularly given the payrolls data that we saw on Friday and that uptick in the unemployment rate. But that services data helped to, I guess, assuage fears and suggest that perhaps the US economy isn't running headlong into a deep and dark recession, that perhaps that there is still that momentum, and that data on Friday was maybe somewhat seasonally adjusted, particularly given the temporary layoffs that we've seen through the hurricane season there in the US as well. So yeah, look, there's still plenty to come, and there are still wounds across markets in terms of that risk aversion and risk sentiment at the moment that still need to play out, and there's every possibility that we see a period of AUD softness where we do test some lower lows before that focus shifts back to Fed policy. And moving into September, if we get a 50-point basis cut, which is now looking like it could be a potential move that the Fed may make, then that should be supportive for the AUD, and we see it pushing back in towards that sort of 66, 67 range. But it really requires a recovery in this sentiment for the AUD to get a little bit more of that upward momentum again.
So given we are seeing the market pricing in now 50 basis points of cuts in September and perhaps more to come before the end of the year, what's the likely trajectory of the US dollar?
Look, in that environment, assuming that it's not getting that support from a risk-off mantra that the market's carrying at the moment, that's helped to support some of the losses that we've seen in the US, and every time it's moved lower on Fed rate adjustments or expectation adjustments, the US dollar has found support as that safe haven asset, along with that's helped really fuel yen gains as well over the last 2 weeks, or at least the last week in particular. But in that environment, we would expect to see the US dollar start to correct against those major peers, and as we said, perhaps lend the AUD some support, given that we were the last central bank to begin raising interest rates in that period of higher inflation. We didn't go as far in terms of the scale of those hikes, so perhaps that response in pulling back is going to be later and less severe. So the Australian dollar yield actually looks relatively appealing when we compare that looking out 1, 2, 3 and 10 years compared to those other major central banks. So that should help lend some support to the Australian dollar in that circumstance.
So at this point, does the yen have more room to move?
Look, yeah, at this stage, it all depends on those Bank of Japan updates moving forward.
Yeah.
But a lot of that yen weakness, obviously there is still that gap in monetary policy that we're seeing, but a lot of that yen weakness was on the fact that the Bank of Japan wasn't moving. And now that we've seen them pull that trigger, the market is starting to unwind those positions and those USD longs and those AUD carry trades and starting to put some of that value back in towards the yen as well. So we are still the Aussie dollar test that 90 mark after being sort of approaching 110 against the yen just a few weeks ago. That we could well break below that 90 mark and potentially even move toward the mid to low 80s in pretty quick fashion, depending on what that outlook looks like from the Bank of Japan and if sentiment remains negative.
What are we seeing elsewhere in currencies with, obviously, we've had the Bank of England move, perhaps signs that the European Central Bank has more room to move. How's that playing out, particularly for the euro?
Yeah, look, euro has been relatively steady. In fact, that we saw a little bit of a gain yesterday on the back of, coming out of that non-farm payroll data last week, and even with that ISM services data, the euro still remains steady and edged upward. We'd expect, given that the ECB are still starting from a lower interest rate, but the ECB haven't really gone to the same level of forecasting those same level of cuts that we're expecting from the Fed. So perhaps given that ECB starting from a lower base has a little bit more room to move in terms of being more measured with those rate cuts going forward. They don't have to be aggressive, and that should be euro supportive, particularly if we do see a further unwinding in US dollars. Those funds could start to flow into euro instead as we move forward. But really it all depends on that Fed outlook and risk sentiment for driving direction really through the rest of this month and into that Fed policy update.
Well, it's a bit of a trader's delight at the moment, isn't it, given what we're seeing more globally. Matt Trividian across it, thanks for joining us from OFX.
Thank you.
All right, let's return to what we're seeing on the equity market, looking at some of the best and worst performers on today's market. Now, the uranium producers have been under tremendous pressure just of late. That was triggered partly on Friday by the largest producer, the Russian producer, indicating they're going to ramp up production. That sent the uranium price lower, and those stocks followed as a result. So today, seeing a bit of a bounce back, Deep Yellow and Paladin among the best. Ordinate updating the market prior to its full year results later in the month, and it's seen to be largely negative, certainly in terms of its guidance, and as a result, shares have crashed today. Pro Medicus, certainly also a market darling. It's come off significantly as well on Woodside off the back of a acquisition in ammonia out of the States. Stay with us now for IG reporting season. Hello and welcome to our reporting season spotlight, your shortcuts to the results that matter. I'm Andrew Gagan. Let's have a look at the companies that have reported today, and among them Coronado Resources, Reckon Group and Vista Group also reporting. First to Coronado Global Resources, posting a 10% drop in its revenue in the first half of 24, revenue coming in at $1.34 billion. The company attributing the drop to lower average metallurgical coal prices. Coronado saying it's on budget and schedule with regards to its ongoing projects in the US and Australia. Chief Executive Douglas Thompson saying Coronado continues to focus on organic growth funded by cash flow rather than relying on debt in the challenging market environment of high inflation and increasing taxes. He's also reaffirmed the previously announced FY24 guidance, saying that the ongoing expansion and cost improvement will further strengthen the balance sheet. Let's take a look at other players in the coal space, and we can see mixed results today. Ordinate shares have plummeted as it expects FY25 revenue and gross profit to fall marginally on the previous year. In the market update, the audiovisual tech company indicating full year unaudited gross profit of $44.5 million, which is up 33% on the year, forecasting earnings of between 19.5 and 20.5 million Australian dollars. On the outlook, the company expecting FY25 to be a transitional year, saying it's likely to return to growth in FY26. The share price having fallen more than 30% initially in today's trade. FY24 results are due out on the 19th of August. Here's Mark Garner from MPC Markets and his take on that update.
Yeah, got to question management's decision to provide preliminary guidance the day after, one of the worst days in the markets. Well, for some of the indexes, pretty much, since beyond Black Mondays. So Ordinate open at 650, and obviously that's the danger of releasing. The results weren't terrible.
Bad,
I think most of the metrics were up, high 20%, and I think they doubled their gross profits and things like that. Outlook was a little bit soft, but obviously they were cautiously positive.
And here's what the analysts are saying. Ordinate downgrading Ramsay Healthcare to hold after the company's trading update, which revealed hefty asset write-downs and charges and high interest and depreciation and amortisation charges. The broker doubting earnings margins will recover to pre-COVID levels. Macquarie has retained its neutral rating and a $50.10 price target. JP Morgan saying capital management and progress on cost control were the main focus when AMP announces half-year results on the 8th of August. JP Morgan saying AMP's cost reduction targets, if achieved, would represent material uplift to its earnings. It reiterates its neutral rating, a price target there of $1.20 a share. Tomorrow on the reporting list, we have Arcadium Lithium and Light and Wonder. And that is your reporting season spotlight. Thanks for watching. And welcome back to the close. Let's check the board, see how we are tracking in today's trade following, of course, some very volatile moves. And well, that's relatively benign given what we saw yesterday, currently up 0.4% on the SIBO 200. Just in terms of corporate updates, Woodside Energy will spend $3.7 billion to purchase a gas-based ammonia project on the US Gulf Coast. Chief Executive Meg O'Neill saying the acquisition will push Woodside's move towards energy transition and give an early mover advantage in the growing carbon ammonia market. Global ammonia demand is forecast to double by 2050, with lower carbon ammonia making up to two-thirds of the total demand. Checking some of the other stocks we are looking at today, Treasury Wine Estate, Australia's largest wine producer, saying it plans to divest its commercial brand portfolio and flag a non-cash impairment charge in relation to its premium brands business. Macquarie will buy a data centre in South Korea for $537 million as the artificial intelligence boom drives demand for cloud computing and data warehouses in the country. Westpac has decided to stop offering new home loans through its RAM subsidiary as part of a plan to simplify its business. However, if you already have a RAMS loan, nothing will change. You can still manage your loan through RAMS and its website or call centre. Westpac will keep the existing RAMS loans but won't be impacted financially by the decision, it says. Emerald Resources signing an agreement with MACA Mining to extend its long-standing partnership on current and future mining projects. The agreement grants MACA the first right of refusal on all new emerald mine developments for the next 5 years. The partnership covers a full range of mining services, including drilling, hauling, construction, with rates been negotiated. Well, Uranium Explorer Global Uranium and Enrichment has released its quarterly update, reporting several key updates in its mining projects. For the details and the results, we're joined by GUE's Managing Director, Andrew Ferrier. Andrew, welcome.
Thank you. Thanks for having me.
All right, what are some of the highlights there? Because you're drilling currently at your Tallahassee uranium project in North America. In fact, that's your focus at the moment, isn't it, North America?
Yeah, 100%. Yeah, so Global Uranium is very focused on the North American market. Our main project is our Tallahassee uranium project, which is in Colorado. We actually finished that drill program in the June quarter. It was a very successful program. We had some very thick, high-grade uranium intercepts, which included 66 metres of 0.12% uranium. These are very high-grade results. In the Tallahassee district, which is a project that we have, Tallahassee is one of the biggest undeveloped uranium projects in the US, and we're very excited about pushing that project forward over the coming quarter.
Aside from Tallahassee, you have a couple of other projects in line as well. At Maybell in Colorado, also you have a project in Canada?
That's right. So Maybell's a really good one to bring up because we're just about to start another drill, our maiden drill program on our Maybell uranium project. That's also in Colorado. Drill rig's just arriving to site as we speak, so it's a very, very exciting time for us. We plan on drilling 40 holes there over the next 4 to 6 weeks, and we're very excited about getting those results out to the market. Maybell is an existing producer, produced over 5.3 million pounds of uranium in the previous uranium booms. We've pulled this project together over the last couple of years, and it's the first time we've been able to get a drill rig out to it, so we're very excited about what the potential of that project could be.
What's the most promising then? Is the focus on Tallahassee, and what sort of timeline roughly are you giving there?
Yeah, our focus is really Tallahassee. We've now completed that drill program, and what we're moving on to now is a scoping study, which we plan on getting out to the market by the end of the quarter. So that's the end of September this year. And that scoping study will really show the key attributes, positive attributes of that project to the market. As I said, it's a very large project. We're excited about getting out to our shareholders what we think that project could be in the years to come.
Drilling can be costly. How's your funding at the moment?
Yeah, that was another good thing about putting out the quarterly report. It shows that we're well funded till the rest of the year. We've got $4.6 million. So we've raised money early in the year. We're very blessed by that. And now we're just executing on the program, which we've raised the money off the back of. So that's a great thing for us. And we'll continue to have a lot more milestones and announcements coming out in the next couple of weeks to months.
How do you view the uranium market at the moment? Of course, it's been extremely volatile just in the past couple of sessions, pretty much reflecting also what we're seeing more broadly on markets. But I gather part of that was triggered by what the world's largest uranium producer in Russia actually announcing it's going to ramp up production.
Yeah, that's right. There was a bit of a shake in the market where essentially what people were expecting was to be maybe a cutback in production. Actually saw that they were increasing production. That was for this year. They still haven't provided guidance for 2025, which they will do in late August. So I think, and what many people are expecting to see is that it's actually a lot harder to get uranium out of the ground moving forward, and any cutback in production that will come out there will have a very positive impact for the market. So it's still very delicately balanced. There's a structural supply deficit moving forward for the next couple of years. So we're still very favourable on the uranium market moving forward.
Okay, of course, broadly supported too in the states where you're located critically, as the US Senate recently passed that bill to ban Russian uranium imports, I should say.
Yeah, it was a really important moment for us, and one of the reasons why we're so excited about being in North America is that, the US uranium industry, US still has more nuclear reactors than any other country, has become very reliant on Russian uranium over the last couple of decades. They've come out now and basically banned Russian uranium as of August this year coming into the US. So that sets us up very well, one, because we have undeveloped uranium projects in the US. They're obviously going to look to source uranium moving forward from either domestically or friendly countries such as Australia and Canada. But we've also invested in Ubarium, which is an enrichment company. And what that ban in the US was very particularly focused on was enriched uranium, not just yellow cake. So we're really well positioned on multiple fronts at Global Uranium to take advantage of this sort of, the uranium market sort of splitting and becoming bipartisan moving forward.
It goes to that broader story, I guess, and clearly proximity is the key for you, given the US is such a large market for nuclear energy.
Yeah, it is. Like, we're in Colorado. It's a long history with mining. The sort of the key states in the US are sort of Texas, Wyoming, and Utah. There's a conventional uranium mill in Utah, not too far away from both our Colorado projects. So yeah, location is very important. And the US, is going to need to see a lot more uranium produced moving forward.
Andrew, terrific to get the update from GUE. Thanks so much for joining us.
Thank you very much. Checking the share price, we can see it is actually off 9.5% today. Andrew Ferrier is the Managing Director of Global Uranium and Enrichment. On to other news. Australian software company Reckon has posted a half-yearly group revenue of $28.4 million. That's up by 1% on the previous corresponding period. Earnings up 6% to $11.7 million in the half year. The business attributing its momentum to its cloud-based subscription offering, which saw revenue rise by 8% to $13 million. Vista Group posting half-year earnings of $7.2 million. That's up 4.7% from the same period last year. The global leader in providing tech solutions to international film industry, reporting a total revenue of just shy of $70 million, which is a loss of $2.5 million. Checking those shares today, we can see that Reckon has come off substantially. Time now to get some tips and tricks for traders and to tell us how to not blow up your trading bank during these volatile markets. Mandy Rafsanjani joining us now from Trading Psychology. Mandy, welcome back to Ausbiz. Great to catch up with you, of course. What a time in markets. It's all about holding your nerve, isn't it? So what are you seeing out there and how are you actually responding to it?
Oh, Andrew, I tell you, these are the times when fortunes can be made. But you know what? Based by the emails I received in the last few days, it's where fortunes are being lost. And it's really interesting. I mean, Daniel Kahneman, he was such a blessing for the finance industry and put that on his book, Thinking Fast and Slow. And he talks about how people naturally can't make good financial decisions. And we see that in those fast moving markets, right? And, I have traders who lost their portfolio and lost their trading bank, and have traders who made their money for the year. And this is what Linda Rushke, the market wizard, always says: you only need 1 or 2 good months in a year to make your whole year. And that often gets lost in translation, I think, when it comes to all these fast moving markets and the fears kick in and we can't think clearly anymore.
Well, how do you take a clear approach to what you're seeing at the moment? Because of course, investors are asking right now, is the time to buy? Could the market fall further? It's one of those precarious sort of situations, isn't it, as to whether you actually be a hero and start buying.
It's so tricky, and there is no clear yes or no answer, and that's why trading and investing is so amazing because of all the uncertainty we have to deal with. We love that challenge, right? So I had a trader yesterday, he's more of an investor, and he called me in panic. And he's like, oh my God, the news says it's the worst market, in the last since 1987, and should I get out? So he is mostly invested in the American market, and he has a portfolio manager. And so he says, I've got 1 hour to make that decision because the market opens up at 2:30. So he's based in Switzerland. Sorry, 3:30 it opens up here in Europe. And so I'm like, okay, so what is your decision-making process? He says, I don't know. So we can already see, number one, he was not prepared because the market has just been going up, and he had no clear, logical, rational, structural thinking on how to make a good decision. That's number one. The second part was that he actually got out in the 2020 COVID crash. He closed everything out. And then, of course, the market rallied all the way back up. He got punished for getting in, doing the right thing. And then now we have what's called a recency bias. His brain now thinks back to the time in 2020 when he made the mistake, got punished, and he doesn't want to be in that same situation. So yes, tricky.
Absolutely tricky, Mandy. So what are some of the key mistakes that traders make in a market like this?
Yeah, so that's very different to investors, right? So the investors, they have to make a more of a longer term decision. Do I stay in? Do I get out? How do I reposition myself? Traders, they're more on the short term. And I saw, so very common, Andrew, and I haven't figured out why is yet, but when the market has been up extendingly, traders start looking for shorts. And the opposite is when the market has been down a lot, traders start looking for longs, even though there has not been any long entries. It's just a feeling, an urge that they have, that they don't seem to be able to resist. So yesterday, a trader contacted me, actually overnight, he said the market is so overextended, it needs to be like a slingshot. It needs to come back up. So from the time the Dow opened, he's an American-based trader in New York, the Dow opened, he started going long, and the Dow kept going down. But then he switched to the NASDAQ, tried to do the same thing, didn't work. And by the time when we had that slingshot, when it came back, he was out of money. He had lost so much money, and it was like, little losses, which turned to a big loss. And then he missed out on this epic reversal that we had overnight.
All right. So, Mandy, what are the key tips you have then to negotiate a volatile market?
So number one, when you have to make your trading decisions, if you stay in, if you stay out, more investment decisions, don't look at what loss you have made. Look at how much capital you have left. And this is what I really see my big successful traders are doing. Anyone who makes more than 6 figures a year, they don't look at the individual loss, right? Of course, no one wants to take a loss, but they don't care if they've made $1,000 or $10,000 loss, or some, even $50,000 losses per trade because they trade big. They look at what is my overall performance? How does my strategy behave in this kind of markets? Like mean reversion strategies don't work in these algo-driven markets that are being sold off, right? And so how does my strategy perform in those markets? And how can I manage all the urges? So be aware of what your natural tendencies are, because we're human, and then manage them. And again, this is where Daniel Kahneman did all the great research. For example, the recency bias that I mentioned, for example, the framing. So framing is, do I look at my loss through an individual thing, like how much is that loss? Or do I look at that loss in context of my capital? How much money do you have left to still work with it?
Yeah, it's all about taking that emotion out of the trade, isn't it, Mandy? Terrific to get your tips there. Thanks so much for joining us on Trading Psychology.
Thank you so much for having me.
All right, now we are preparing to head to the press conference held by Michelle Bullock, the Reserve Bank Governor. This is, of course, off the back of that decision by the Reserve Bank to leave rates on hold at 4.35%. We did get that accompanying statement, plus the statement on monetary policy as well, underlying that they remain focused on inflation and returning it to target, saying within a reasonable time frame. That's its highest priority, it's reiterated. saying that inflation at this point in underlying terms remains too high, saying the latest projections show that it will be some time yet before inflation is sustainably in the target range. As expected, the Reserve Bank leaving rates on hold. Of course, it was only a couple of weeks ago where the suggestions perhaps that may need to hike rates to tame inflation. We got that fairly benign reading on inflation for CPI for the quarter last week. Well, let's now cross to that press conference from Michelle Bullock.
I hope you're enjoying a slightly more spacious experience than the previous press conferences. So today, as you know, the board decided to leave the cash rate unchanged. For now, the board judges that the level of the cash rate is appropriate for balancing our inflation and employment objectives, but there is still some considerable uncertainty about the outlook. And I want to highlight here that there is still a risk that inflation will take too long to return to target. So the recent CPI data were broadly in line with our expectations, our forecasts, but make no mistake, inflation is still too high, and the board does remain concerned about the degree of excess demand in the economy. Now, what I mean by that is that the amount of goods and services that households and businesses and government want to buy and need, that's more than the amount that the economy can sustainably provide, supply, if you like. To paraphrase what I heard someone say quite simply the other day was, inflation is when there's too many goods chasing the same amount of things. And when demand's above supply, that's inflation. Prices go up. So demand has been above supply for some time now, and we've been highlighting this, and that's the key reason why inflation's been so persistent. So you'll recall earlier when in the pandemic and the immediate post-pandemic period, we had difficulties on the supply side of the economy. There were things like shipping backlogs, there were shortages of certain goods, and this overlapped with a period when people were demanding a lot of goods. So there was a substantial increase in energy costs as well at the time when Russia invaded Ukraine. And all of these things conspired basically and resulted in higher goods price inflation around the world, and that was the case in Australia as well. Now, these supply shocks have largely now worked their way through the system, and what we're dealing with is continued strong demand, particularly for services. And we're using the tool we have, monetary policy, to operate on the demand side of the economy. We're trying to bring demand back into balance with supply and get the inflation rate back into the target band of between 2 and 3%. But the fact is that the progress on bringing inflation down has been very slow for a year now. And while growth of demand has been slow, there's actually no guarantee that supply and demand will return to balance quickly enough. So what we really need to see is the underlying pulse of inflation, and we sort of look about that as the trim mean, to start to come down further. Because the longer inflation remains elevated, the more it hurts everyone, all Australians. So we really need to stay the course in this to try and bring inflation back down by slowing the growth in demand. Now, the board also discussed the rise in volatility that we've seen in global financial markets after the last couple of days. In part, this is reflecting the markets adjusting to economic news in a period where there's already considerable uncertainty about the outlook, and we'll be keeping an eye on this as you'd expect. Now, finally, I'd like to make a few observations on the Australian economy. So you will have seen in the outlook today, in the Statement on Monetary Policy, we've revised up our forecast for demand growth, and that's due to stronger forecast public spending and an expected pickup in household consumption. We've got conditions in the labour market easing gradually, but they're still tight. Average hours worked and the participation rate have been holding up. Vacancies have come down, but they're still higher than they were before the pandemic. And wages growth appears to have peaked, but it's still high. And the growth of unit labour costs, and that's what it's actually costing businesses to employ workers for what they output, that remains elevated. And that's a key reason for that is because productivity growth remains pretty slow. So these are all the forces that you think inflation might remain a bit higher for longer, and that might result in interest rates remaining higher for longer. But there's also risks in the other direction, which we also highlight. It is possible, for example, that household consumption growth will pick up less than anticipated, and that might be if households are a bit uncertain and they choose to save a bit more of their income than we're currently expecting. There's also some signs that the business sector is under a bit of pressure, that the business outlook isn't as rosy as it was. And although overall employment growth's been strong, much of this has been driven by developments in a narrow range of sectors such as health and education. Jobs growth in some other parts of the economy has weakened quite a lot. So we're setting policy for where the economy is heading, not based on where we've been, and that's the challenge. There's a high degree of uncertainty about this. We're coming out of an extraordinary period of massive supply shocks, a near zero cash rate back in 2022, massive fiscal support for the economy, all part of the pandemic and the pandemic response. And it's not surprising really that it's taking time for things to stabilise a bit. So based on what I know today and what the board knows today, what we can say is that a near-term reduction in the cash rate doesn't align with the board's current thinking. We've seen from overseas experience how bumpy inflation can be on the way down, and across the economy we need to see demand and supply coming back into better balance. Now, I understand that this is not what people want to hear. I know there are many households and small businesses that are struggling with interest rates where they are. Many people are doing it tough, and we're very conscious of that. The board's very conscious of that. But really the best thing we can do, and I've said this before, the best thing we can do is to bring inflation back down to target, because we can't let inflation get away. It hurts everyone. It particularly hurts people on lower incomes. This is why we need to stay the course on bringing down inflation until it's sustained in the band of 2 to 3%. So thank you for that, and I'm happy to take your questions.
Thank you. Peter Hannam from The Guardian. Did the RBA consider a rate rise at the meeting, and what stopped you, given financial conditions are less restrictive than you thought, demand continues to remain above supply, and the underlying inflation rate has fallen very little over the past year, as you've mentioned?
Yes, the board did consider a rate rise at this meeting, as well as a hold. What's the board is where the board is now is that inflation is forecast to come back into the band at the end of 2025. If you look back, that's exactly where we were in November last year. Inflation coming back into the band at the end of 2025. The board is trying, as we've said in the past, to steer a narrow path here, not result in a spike in unemployment. We want to try and keep employment growing if we can. And the judgment of the board was that keeping the interest rate where it is and making sure that people understand that a rate cut is not on the agenda in the near term, given what we know, that continued pressure will help to keep demand coming back into line with supply. That's the judgment the board's made. But I should say that they are vigilant to the upside risks, and if it does appear that inflation is not tracking the way we are forecasting, then they will, if needed, increase interest rates.
Governor Fiona Willan from Sky News. How much of a role did the market volatility play in today's decision?
Yeah. The board discussed it, obviously. It didn't play a role in the decision itself, but it is of interest and we do need to watch it. The trigger for it, as you know, was poor employment numbers in the United States, and then coupled with a raise in interest rates in Japan, there was a sense in which there was an adjustment of people's expectations to economic conditions in both those countries. But there was also an adjustment in terms of expectations. I think there was, in the equity markets, I think everyone felt that perhaps it was a bit rich, the valuations in the equity markets, particularly in the United States. So I think there's been a readjustment there, and there's also been a readjustment in investors who are indebted, who have leverage and have leveraged up into assets, and they're now trying a little bit to think, well, perhaps we better pull back a bit. So there's some sense in which it's based on economic fundamentals. There's also a sense in which it's volatility as a result of people trying to adjust their positions. So we're watching it very closely. I think things have settled down a bit today, but it was one employment number in the United States. And so I think we just need to have a little bit of caution and a little bit of calm.
Michael Reid from the Australian Financial Review. Governor, in November 2023, your old boss Phil Lowe said if central banks pushed out their timeline for getting inflation back down to target out to 2026, the community will, and I quote, rightly say, are they serious? Has the board's opinion about the acceptable deadline for taming inflation changed over the past year? And is your new forecast of December 2026 for midpoint inflation a hard red line for you and the board?
It's hard to talk about hard red lines in the context of the forecast because, as you know, Michael, the forecasts are inherently uncertain. And that's to get back, we're looking to get back to the middle of the band. I've said before that if we can get back into the top of the band and continue the downward trend by N25, which is the current forecast, then I think that we'll be on a really good track for that. So I wouldn't set middle of next year, middle of 2026 as a red line in the sand because, quite frankly, there's a lot of water to flow under the bridge by then. And if the board feels that in the next 6 to 12 months that we're not tracking back, we're not even tracking to get back into the top of the band by the end of 25, then I think there'll be some very difficult decisions to make.
Governor, John Roll from the Daily Telegraph. You used the term near term about 5 minutes ago, and until about 5 minutes ago, I'm sure there were plenty of people who thought that a rate cut might be coming later this year. Could you please explain exactly what you mean by near term, and if you could put an actual time frame on that? Do you mean but I just mean what does near term? What is the difference between near term and medium term when you use that expression? Okay.
So I'm going to obviously preface this by saying no forward guidance, but near term, I think what our feeling, the board's feeling, is that the market path at the moment is pricing in interest rate reductions by the end of this year. I think the board's feeling is that the near term, by the end of the year, in the next 6 months, that doesn't align, given what the board knows at the moment and given what their forecasts are, that doesn't align with their thinking about interest rate reductions at the moment.
Nadia Daly from the ABC. Governor, markets are saying rates should be lower. Have the markets got it right? And is a recession on the way?
So the markets, it's interesting. The markets are saying that they expect us. They're betting their money, if you like, on that's what we'll do. I guess there's a question about whether or not, I wouldn't say are they right or not. They're trying to guess what we're going to do. And what I'm trying to tell the markets today is that I think they've probably expectations for interest rate cuts are a little bit ahead of themselves. Are we heading for a recession? I don't believe so, and the board doesn't believe so, because we still believe that we're on that narrow path. Having said that, we are data dependent, and there's a number of things, as we mentioned in the Statement on Monetary Policy, that could result in the economy slowing much more quickly and inflation coming down much more quickly than we expect. And we need to be alert to those. And if they come to pass, then yes, interest rate cuts would be on the agenda. But at the moment, given what we know at the moment and the forecasts, as I said earlier to John, the near term interest rate cuts are not in the agenda.
Governor, Tom Dusevic from The Australian. Since the May statement, growth in public demand has nearly tripled by the end of the year, from something like you're expecting 1.5%, it's now 4.3%. Is public spending keeping interest rates higher for longer?
I talked a little bit about this at the last press conference as well. I think it's very difficult in our forecasting framework to think of public demand by itself. You can't think of it by itself. You've got to think about it in the context of everything else that's happening. And yes, the public demand has been revised up, but there's other elements of the economy in which demand has been revised down. And the extent to which public demand is offsetting weakness in private demand, it's not necessarily putting upward pressure on inflation. So I would encourage you to think a bit more broadly than just narrowly focusing on what one item went up when there's actually other items that are experiencing more weakness. So, I think with our forecasts as they are, you will see, as I said earlier, that we're getting back into the band at the end of 2025. lots of uncertainty around that, and lots of things can go wrong on either side. So we just have to be alert.
Hi Governor, Millie Murray from the Sydney Morning Herald. Why has the bank downgraded its forecast for wages, and at what point or under what conditions, if not now, would wage growth begin to add to inflation pressures?
I'm not the head forecaster, so I couldn't give you the technical specifics of why the wage forecast has been revised down. What I can say is that we have observed in the recent wage data that it does appear to have peaked, and it is easing a bit. And as you would expect, as our forecasts going out see the employment market soften a bit, then we would expect to see wages growth soften a bit as well. Made earlier, though, was that what adds to inflation is unit labour costs. And unit labour costs are dependent upon not just wage rises, but also what's happening to productivity. And productivity is difficult to read at the moment. It has been influenced by the pandemic. It's been very volatile. We do expect it to get back towards its trend level in the next year or so, but it's possible that at least in the next year or so, if productivity doesn't improve, then even wage rises of around 3.5% might not be enough to keep unit labour costs contained. Now, unit labour costs are part of what goes into businesses' costs. The extent to which they can pass them on depends on the level of the demand in the economy. And as demand in the economy slows, then it's possible that it will get a bit more difficult for business to pass it on. So it doesn't necessarily mean that wage rises just automatically get passed on into prices at all. It all depends on what else is happening in the rest of the economy.
Michelle Swati Pandey from Bloomberg News. Just if you could give us some flavour around the discussion on recent market volatility that happened at the board meeting today. At what point does this become a concern for the central bank? And also with this easing cycle that is starting globally, RBNZ is seen cutting next week, Fed maybe mid-cycle, which probably is overdone but could be. Is there any peer pressure at all? I know you're pushing back against interest rate cuts, but if there is this wave of easing.
Peer pressure. Yeah. The discussion on volatility, we had some briefings on that yesterday and today because of what went on overnight. It was really just to understand what was going on, what was the reasons for it. I think there was a bit of a feeling that it was a bit of an overreaction in some ways. It was one number, but it was a reassessment by some parts of the market as to the US economy. And I think the board discussed, well, you know, how much signal do you take from that? I don't think they took a lot from it, but they accepted that they needed to just keep an eye on it. But things have settled down a bit today, and as I said earlier, the dramatic reaction in the equity market in particular, at least partly driven by investment decisions. People who were borrowing in Japan and investing in the United States all of a sudden leveraged, finding, oh dear, maybe I better reverse this. So there's a lot of sort of fundamental stuff going on as well. So I think we just need to wait and see. But the board, it didn't, as I said earlier, it didn't factor into the board's decision on what to do with interest rates today. On the peer pressure point, I mean, interestingly, I think other countries have experienced a little bit of this as well. A lot of commentators are saying, well, no one can go till the Fed goes. Well, that's not true. Canada went, Sweden, Euro, UK now. So point about a floating exchange rates is you do have a little bit of flexibility. You still have to consider what's going on in other economies, but you can focus a little bit on more on your domestic economy. You do have to watch what happens to your exchange rate, but the beauty of the floating exchange rate does give you that flexibility. So I think I would resist peer pressure.
Thanks, Governor. John Keogh from the Australian Financial Review. You said earlier that the board today considered a potential rate rise or holding rates pat as you did. How serious was the contemplation of a rate rise? Was it any more likely or more serious than any of the meetings you've had since you last raised rates in November last year?
It's a difficult sort of judgment to make, I suppose. It was a very serious consideration. There were only two things on the table: hold, and hold accepting that we might have to hold for some time, or raise. And I think the board felt that the risks associated with raising at this point, as opposed to holding where we are and just staying where we are, warranted the second alternative, which is what we did.
Hi, Governor. Stella Chiu from Reuters. When asked about the headline CPI, so according to your forecast, it's expected to return to the top of the target band by the end of this year. So is that going to have an impact on people's inflation expectations, wage setting behaviours, and do you think that increased the public pressure for you to cut?
Yeah, no, look, we actually put a box in the statement on monetary policy talking about the headline and the underlying inflation, if you like, the trim mean. The headline in the next year or so, as we know, is going to be quite impacted by the temporary impacts of the energy rebates in particular. And what will happen is that it'll lower the headline inflation rate, and then it'll pop back up again after the rebates roll off, and that's in our forecasts. We think for the moment the best indicator of what underlying inflationary expectations are doing sets in the trim mean. We think that's the best indicator. Over time, you'd expect the two of them to go together, but the trim mean smooths out the volatility that you tend to get in the headline. Now, to your question, will it affect expectations? Yes, I think that if people see a number with a 2 in front of it, it might affect expectations. It might affect at the margin some people's thoughts on wage rises and so on. So I think it might have an impact. And that might ultimately have a flow through to the underlying inflation. But I think broadly people understand that we're about the underlying inflation pressure here, and just because it pops down briefly for a few quarters under 3 and then pops back up, I think people would understand that we're in here for the long game. We're not in here for the quarter-to-quarter movements. So that's the message that I'll try to be getting across to people, is that, yes, be aware that these things are happening, but they're short-term. And what we're focused on is making sure that the underlying inflation is coming down steadily below that.
Thanks, Governor. Poppy Johnston from AAP. I was hoping you could expand on some of the information about business pricing decisions coming out of the liaison program. There seems to be a bit of uncertainty there, perhaps. Can you expand on what businesses and firms were telling you?
Sure. So I think what we're seeing, first point I should make is that I don't see as many businesses as my liaison team do. They're really the experts on this. I obviously get the summaries from them. I think it's fair to say that businesses are finding their cost pressures, labour and non-labour costs, it's not just labour costs, are affecting them. They are seeing those costs. And I think if you went back a year or so, it'd be fair to say that they felt they could just pass those on. Certainly in some of the discussions I've had with some businesses, they are conscious now that it's possibly a bit more difficult to pass it on. That's the impact of demand slowing, demand coming back in a bit. So I think they're still, some businesses are really finding it very, very challenging, and we know this from insolvency numbers that that is rising now from very, very low levels. But a lot of businesses are feeling the cost pressures, and they're finding themselves a little bit squeezed between those cost pressures and the ability to put prices up. So I think that would be a reasonable summary.
Michelle, Cécile from the Financial Review. You factored in rate cuts and government subsidies in your forecast. How confident are you that we won't see a revival in consumer spending?
Sorry, rate cuts in government, what?
In your forecasts.
So we've factored in tax cuts.
And rate cuts and tax and government subsidies in your forecast.
Okay.
Where the cash rate will be.
Okay. So the cash rate assumption, and it is an assumption, is a technical assumption, and it is just the market path. So if you read the forecasts and you think about that, that would suggest that if the market path is for a cut in interest rates and there are no cuts in interest rates, then you might expect that the forecast for inflation coming into target might in fact move a little bit, depending on how big that difference is between the technical assumption and what actually transpires in terms of rate cuts. So I don't want people to get hung up on the technical assumption, but it does tell you something about where it's a benchmark, if you like, and if the rate path is higher than that, then that will tell you something about what might happen, what direction our forecast for inflation and the economy might go. So that's to that point. In terms of the subsidies, look, yes, in theory, that if you give people subsidies for, say, electricity on their power bill, they're spending less on their power bills and they've got a little bit more money to spend. How significant is that? I don't think it's hugely significant. I mean, $300, $75 a quarter. Maybe it's one cup of coffee a week. I don't know. I mean, I don't think that it's going to be that significant in terms of consumption outcomes that it's going to change our forecast markedly.
Governor David Taylor from the ABC. Philip Lowe used to receive letters on his desk. I assume maybe people emailed them or actually sent physical letters and telling them how they were feeling, letters from the public. And some of them are pretty distressing. You've been in the job long enough now to people know who you are and what you're about. Have you been receiving letters, and have some of those letters been quite distressing from mortgage borrowers and what sort of finances they're facing?
The answer is yes, I have, and I do read them, and yes, some of them are quite distressing. I understand that monetary policy is a blunt tool and interest rates is a really blunt tool. But the point I would come back to, and I've made it a number of times, is that it's not just interest rates hurting those people, it's the cost of living. It's the fact that inflation has been so high now for a few years, and they're not used to seeing, and they don't want to see, the prices of their essentials going up at the rate they are. So the most important thing that I and the board can do is to get that inflation rate back down. So I do understand that, and as I said, I do get letters that tell me this, I do understand that, but really getting inflation down is really the key to this ultimately being resolved so that households can just get on with their lives and not have to worry about this.
I always ask a follow-up question, which is probably does it affect you personally?
Yes, it does. It does affect me personally. I do find it difficult to read some of them, I can't respond to every single letter I receive. Some I do try to respond to, but it's difficult, to read about it.
Governor Juliet Sarli from Ausbiz TV. You mentioned a couple of times that the market volatility has been by one US unemployment number. There's also the thought that it's very much a Fed policy misstep. They were too slow to hike, they've been too slow to cut. Are you worried about a policy misstep given what David just talked about and how distressed many Australians are?
Well, yes, we are worried, and that's why we're worried on both sides of this. We're worried on the one hand that inflation might stay higher for longer, which is bad for everyone. On the other hand, we're worried that if certain things transpire and the economy slows more quickly, more people lose their jobs. That's not great for people either. So we're worried on both sides. This is the nature of monetary policy. It is really uncertain. We have a lot of data which is telling us what went on in the past. We have survey data and liaison data which tries to give us a handle on what's going on in the future. But what ultimately happens to the economy is the outcome of the decisions of 25 million individuals, millions of businesses. No models can capture that. We try our best. We are trying our best to think where we think things will be and how high we have to have interest rates in order to deliver a low inflation rate, but it's inherently uncertain. Now, a couple of other points I'd quickly make is that we didn't go as high as the Fed. Our interest rates are lower, and that's been used against us. People have said, well, some commentators are very certain that we haven't gone high enough and we need to go more. And that, I think, means that we're maybe not quite as restrictive as some other countries, but we think we're restrictive, but we've chosen that because we've deliberately tried to follow this narrow path of bringing inflation back down at the same time as we are preserving what we can in the labour market. It's uncertain and we are very alert to the risks, but we're doing our best.
Governor Jonathan Shapiro from the Financial Review. Central banks often talk about the lags in monetary policy. It's been a fair amount of time since the RBA has raised interest rates. So my question is, has the RBA changed its view on how long those lags in monetary policy are? Because if the RBA is saying there's no capacity in the economy, then how does it expect to bring inflation down?
No, I don't think we have. I mean, I think we think the lags are sort of up to 18 months for interest rates. If you just look at the cash flow channel, which is only one part of the channel, so it's the cash flow channel has probably been a little bit slower this time because of the prevalence of fixed rate mortgages, and that's still rolling off. And if you, I think it's in the Statement on Monetary Policy, you'll see that we're still predicting that debt repayments are still going to be rising a bit over the next little while. So there's still a little bit to come there in terms of that channel. I don't think we feel that the lags, long and variable, have changed necessarily, but obviously we need to be very alert to that. And if it turns out that the previous interest rate rises have, we think, washed through the economy and we've still got inflationary pressures, then there's a difficult decision to make.
Jennifer Duke from Capital Brief. I was curious about whether or not you agree with some economists' perspectives, including some who've previously worked here, that Australia will shortly follow the kind of global disinflation trend in a very, very similar way, such as to the US, and whether that might suggest we're in for a similar rocky ride down the track. And on the point of being data dependent, the monthly data has been pretty volatile for inflation to the point where it surprised a lot of people in the June quarter. Has that data actually been helpful to you, or has that been more difficult in determining what's going on?
Okay. So on the CPI, we've always been a little bit cautious of the monthly CPI because of the reasons you highlight. Having said that, we've taken some signal from the monthly CPI, and I think it's fair to say that taking too much signal from it, as some people did, turned out to give people a bit of a wrong steer in terms of how high the inflation rate might be. I'm looking forward to getting a full monthly CPI. It's going to be great. So yes, it is very challenging. In terms of what other commentators, it's really funny actually. Over the last week, I've read commentators with absolute certainty that we must lower interest rates now. I've also heard commentators with absolute certainty that we must raise interest rates now, and I wish I had their certainty. So I think, yes, it's possible that we are just lagging and the disinflation will occur here as well. But I wanted to highlight for you something that I've said before again, and that is that services inflation around the world, notwithstanding headlines, if you look at services inflation, it's all elevated. It's all around 5 and 6. Everyone's around about the same. And the difference for us is that our goods price inflation is a bit higher than overseas. And a big reason for that is that we have new dwelling construction costs in our goods CPI, and that is continuing to rise by about 5% a year. And that's not in other people's CPIs. Everyone addresses housing costs in slightly different ways in the CPI. So that's what's sort of elevating ours. But inflation around the world in terms of services is bumpy, and it's going up in some countries again. So we've got to take some signal from overseas, but I think we do need to focus on our own domestic economic conditions, and that's where our judgment that demand is still elevated relative to supply comes in.
Thank you, Governor. Jessica Wang from Newswire. Given the serious consideration the board gave towards a rate rise ahead of today's decision, has the likelihood of a future rate rise increased since the board's last meeting?
Oh, probabilities, that's a difficult one. I wouldn't say it's increased. I would say that the board, though, are remaining very vigilant to the risks that it will continue to shift, that our getting back to target will continue to shift out. Now, they think it's where we are at the moment in terms of our central forecast, we're fine. But if it looks like that's shifting out again, then I think the board, the likelihood or the probabilities of an interest rate rise do increase. But at this particular one, I think over the last few meetings, some of the data we've had have just raised the alert a little bit for the board, and that's why you will have seen in some of the statements that the statements have highlighted vigilance to the upside, not ruling anything in or out, but vigilance to the upside.
Hi, Michelle. Michael Heath from Bloomberg. Just want to take you back to Wednesday and the inflation report, which we sort of haven't really touched on because so much has happened in between. How nervous were you ahead of that, and how close did the RBA come to slipping off that narrow path? I mean, it was getting pretty thin until it sort of came in under forecast and everyone calmed down a bit.
Yeah, sure. Well, I was worried. I mean, our forecast, as you know, was basically what we pretty much got. So I was worried, given the taking some signal from the monthlies, that it would be higher. And I think in those circumstances, it was going to be a very serious discussion about whether or not monetary policy was tight enough. As it turns out, the numbers come on basically where we forecast. And there was a little bit of good news in the sense that there was a reasonably broad based in some of the market services categories that show still too high, but a little bit of easing in some of those market service categories. It wasn't just one or two. There was reasonably broad, still far too high, but starting to ease off a little bit. So we took a little bit of encouragement from that, I think. But I'm back to my earlier point that the inflation rate is still too high, and it needs to come down to under 3% in that 2 to 3% band. That is our aim. Well, I mean, it's difficult to say. Not necessarily. Not necessarily. I mean, it still might be that you might be able to maintain the narrow path with slightly higher interest rates. We're balancing risks on both sides. We think broadly, I think that the staff forecasts basically see the risks broadly balanced on both sides of this at the moment. But it's still possible that you could end up on the narrow path. But at the moment, we're focusing on the narrow path with interest rates where they are. And I'll come back to the point I made earlier, which was that at least what we know now and the forecasts, that implies that no near-term reductions in interest rates.
Governor Misa Hunt from LinkedIn News. I'm wondering about the return to office mandate. 500,000 public service sector workers being called into the office. Are you worried that that might have an impact on services inflation, particularly around transportation, dining out, and the whole point of the exercise is to stimulate the demand side of the economy in the CBD. Do you have any concerns around that contributing to services sector, services inflation across Australia?
No, I don't really, and I don't know what sort of our experience is that some people are loving coming back into the office, others not so much. So with the mandates, that might make it a bit more challenging, but as the labour market eases, it might be a little more difficult for employees to leave one job and go to another as the labour market eases. So. But I don't have any particular concerns that I think it'll add to services inflation, no.
Sofia Rodriguez from Central Bank Intel. Now, at the June board meeting, one of the questions the board couldn't answer was whether policy was sufficiently restrictive. Now, in the SOMP, your staff's assessment is that it is restrictive. But I'm a little intrigued with this line in the cash rate statement, which says policy will need to be sufficiently restrictive. Is it need to be or will need to remain?
Well, it needs to remain sufficiently restrictive. That was a forward-looking sort of point, if you like, that it needs to be sufficiently restrictive. That's a statement of fact, if you like. So we weren't trying to say it's not restrictive enough now, or it's got to be more restrictive in the future. It's just a statement of fact that it needs to be restrictive enough to bring inflation back down.
And is that language a bit similar to what Bank of England had back in March, I think? I
couldn't tell you.
And then went on to cut the policy rates. I'm just wondering whether this is a language which says that the cash rate is more likely to remain unchanged for some time.
I couldn't tell you about the Bank of England, what the Bank of England said. I'd only observe that the Bank of England, the Fed, Bank of New Zealand, all have interest rates up above 5. Bank of Canada did too. We don't. And a number of people have remarked on this. We think we're restrictive. We're possibly a bit restrictive, less restrictive than some of those economies. Depends on what you think the neutral real interest rate is, but possibly. The point is that a lot of them are coming down, and I think the Bank of Canada has said this. They're coming from quite restrictive to less restrictive. They're still restrictive. So we're operating with our narrow path idea that we are restrictive enough, and if we keep the restrictive enough, then we will get back into target band in the time we need to.
Governor Michael Statutory Financial Review. A question about the level and growth. On the one hand, you seem to have increased your estimate of the excess demand gap in the economy, and that's both on the higher demand and weaker supply. Some people then also, on the other hand, point to weak growth in the economy and suggest, the economy is really slow, you need to cut rates to fuel growth because the economy is really weak. The question is, what's behind, do you think, your estimate of the lower supply capacity in the economy? And given this higher excess demand estimate, is there really any scope, for example, consumer spending to increase at all from here on?
So, as you would know, estimates of productive capacity, supply, potential supply, they're very difficult to estimate. And we do have a go at looking at output gaps in our statement on monetary policy, and you'll see very wide bands around the estimates. It's notoriously difficult. The reason we have revised our thinking on that a bit is mainly because of what we're observing in inflation. So it's what we're observing as the outcomes. Inflation's been a bit more persistent than we were expecting. Wage rises are coming off, but the labour market has been a bit tighter than we expected. So these things are telling us that perhaps our assessment of the demand-supply gap was a little too narrow. We weren't as narrow as we thought. So I think that, as I said, there's two things going on here. There's partly a demand story. The supply story is partly a productivity story as well. But again, these are very inherently difficult estimates. I wouldn't want to hang my hat on the precise estimates of these things. But what we're taking is signal from what we're observing in the economy in terms of the inflation outcomes and the labour market outcomes. That's where we're taking the signal from. So don't read a lot into it. So.
From Barangaroo Studios, the Ausbiz COB is the key stuff you need to know about the day in business and finance.
Well, hello. Welcome to the COB. I'm Nadine Blaney. It's great to have you here with us on RBA Day. Also, potentially, we'll be calling it Rebound Day, maybe across the globe. Let's see. It certainly happened in the Asian markets and including our own market, which did close higher by about half, close to 0.6%. There's the CIBA Australia Index, but I can tell you that the Yeah, the local S&P ASX 200 has moved lockstep with that pretty much throughout the day. We did see a little bit of an uptick, I suppose, in the last half hour or so, but no immediate reaction to the RBA, leaving interest rates on hold at 4.35%, as widely expected, although, you know, in many people's view, it was a bit of a hawkish hold. So, of course, sticking with the rhetoric that it is all about inflation. Although if you go to our website, ausbiz.com.au, we did have a great panel discussion around about when that decision was handed down. And what I sort of really took away from that conversation is that employment is the next frontier. So whilst the RBA doesn't necessarily want to be at the helm, letting inflation get away with us, they also don't want to be at the helm if we start to see some real sort of negative signals coming from the unemployment market and let that get away with them. So hawkish hold, employment, the next big data point. We'll be talking about that with my guest who's coming in just a moment, Martin Crabb from Shaw & Partner. He's the CIO there. But a story in and of itself is the fact that we have seen Asian markets rebounding for the most part. I will say the Hang Seng is still into negative territory, but the Nikkei up by 8.6%. And also looking at the Chinese mainland market, at least the composite in Shenzhen is up by about 0.25%. So still yet a little bit of weakness there, but the Kospi, after having all of that real sort of fear in the market yesterday, coming back to the tune of about 4%. Week to date here locally, we're still down by 3.3%. So safe to say, volatility is not over. We do have still results in the United States to come through. We've got FOMC speakers, we've got geopolitics, and we've got, that impacting oil along with the possibility of demand destruction. So there's plenty of talk about. Quick run through some of the sectors of the day to see where we saw some of those big falls. Look no further than Woodside Petroleum. So a bit of news coming from Woodside, a bit of an ammonia project that it's bought. Market's not looking on that too favorably from what I can see. Some market talk today coming through that it could exert dividend pressure. Shareholders don't like that. Santos, though, up by about 2%. Cooper Energy in the small end, 2.25%. Tech, well, this was a bloodbath yesterday. And look, picking itself up off the mat today, but you can't say that, we've recouped anywhere near the losses that we saw yesterday. But again, the question always becomes, where are the opportunities? I was a host on the call today. My guests, Sean Hickman from Market Matters and Mark Moreland from Team Invest, they were sort of naming the price that they'd be willing to pick some of these beaten down companies up. If you'd like to have a listen, it is up online. Next DC, it's seeing more bookings coming through, expecting revenue recognition from this contract utilization that it did announce today to start in FY27. The big banks, ANZ is the outlier there, off by 1.2%. Don't forget, we're gearing up to get full year results from Commonwealth Bank. By memory, it's the 17th. I will ask my guest about that one. And some of the top corporate stories today. I mentioned that Woodside Energy buying that gas-based ammonia project on the U.S. Gulf Coast. So I think there's a lot going on with Woodside right now, if you consider that it's also got that bid out for the acquisition of Tellier something, and it's for the Driftwood project in the U.S. Gulf as well. Coronado was out with results today. Revenue slump of about 10% to $1.34 billion. Lower coal prices, but also some weather delays. And Audinate, it wasn't the result, it's foreshadowing the result, providing a soft FY24 outlook, which does imply a large consensus downgrade. Worst performer actually today. Speaking of data centers, Macquarie bought a data center in South Korea for about $537 million. So that AI thematic does continue. And Westpac has decided to stop offering new home loans through its RAMS subsidiary as part of a plan to simplify its business. So that's just putting those stories on your radar. Westpac shares up by about 0.75%. Macquarie Group was down more than 5% yesterday, but today, a bit of green on the screen, up 1.7%. All right, let's get to it. Martin Crabb from Shaw & Partners. Hello.
Good to see you.
Good to see you as well. RBA on hold. We were just listening to Michelle Bullock there. interesting to say that she's saying for all those commentators who were certain there would be a need for a cut or certain that there would be a need for a hike, she's saying, I great that you've got all that certainty, but it's complex out there.
Yeah, she's jawboning the market, isn't she? So the market's got ahead of itself in terms of looking for cuts this year, and the only two options on the table were a hike or a hold. And the statement of monetary policy, which I had to read through before I came down, Nadine, suggests that the economy is stronger than they thought it would be. Inflation's going to take longer to come down. They don't think the government's going to repeat the relief for energy bills. So headline inflation is going to go back to 3.7 in December 2025. So it's going to be a long time based on their numbers till we get into their target band. So we're looking at rates on hold, but we get a couple of bad CPI numbers or a bad wage outcome or something. They can hike. They can still hike. So we'll be interesting to see how the futures curve shifts on that. We've gone from having the Fed now needs to cut like 1 million times before Christmas, and the RBA is on hold. But financial conditions are tight in Australia. They're restrictive. Monetary policy is restrictive. Mortgage rates haven't really come down that much. Business lending rates haven't come down that much. People are still paying 12, 13, 14% of their income on their mortgage. Things are really tight. And yet the Reserve Bank's saying maybe they're not tight enough. So you kind of think that this might be at risk of keeping things too high for too long, and the labour market will start to show up, which is exactly what's happening in the States.
Mm-hmm. Yeah, well, let's talk about that then. Do you think that there was an overreaction? And I suppose that it's so multifaceted. I mean, there's many things that investors, could be worried about.
Yeah.
But it was sort of the jobs data, being the JOLTS, being the non-farms last week. Well, you could say the ISM manufacturing as well.
Yeah.
But, do you think that this has been an overreaction?
Yeah, look, potentially. But the fear is this, that the labour market softens and then it cracks. Like, that's the history, is that when you think about it, if your business lays off 1 or 2 people, no biggie, but they're my customers, so I need to lay off 1 or 2, and then you lay off 1 or 2, and then it becomes 3 or 4 or 5 or 6. So there's this idea that you get this acceleration, and this is what the SARM rule is designed to measure, is that you go and look at what point do you think the labour market's not softening anymore, it's really starting to crack, and that's when that's telling you that monetary policy is too tight, but the train's already left the station, we're going to have a recession. And that's exactly what that payroll number on Friday in the US was telling us. Now, is it 1 month? Was it impacted by weather? Only 450,000 people couldn't work because of weather. So there's all this other stuff in there, but there's just enough in there, and there's enough history. It's a bit like the inverted yield curve. There's enough history to say when that unemployment rate moves like that, that's telling you it's too late. So even if you start cutting now, we're still going to head into a recession.
Yeah. Everybody on Monday morning was Googling the Shaw rule?
The SARM rule,
yeah. I got to say,
yeah,
I might have.
I think you weren't alone. But that's the futures market there for the Fed funds. So we're looking at quite a dramatic shift. We've got a week ago and a month ago just to show you how much the futures market's moved. And at some point we were looking at 50 points in September and 75 in November, which is like probably a little bit overdone.
Yeah, you got to. I mean, we've been here before where you've seen the market really react fiercely, calling for successive interest rate cuts.
Yeah.
Do you genuinely think that 50 basis points is too much to ask from the Fed? Goolsbee was out last night talking again, saying that financial markets not the Fed's mandate. It is price stability, but it's also it's also jobs.
Yeah. Well, he was saying, look, we need to shift from being just inflation fighting to thinking about unemployment. The opposite measure from Michelle Bullock. She's saying we don't have to worry about unemployment, it's all about fighting inflation. So at some point they shift through this dual mandate. They become less focused on one part of it and more focused on the other. So Austin Goolsbee certainly last night was saying we need to think about the economy now, not just about inflation. We think we're done. The luxury they have, for want of a better term, is the 6 weeks till the next meeting, and they'll get another bunch of employment data. Mm-hmm. So if it was a one-off, they don't need to flinch. I think they would prefer to do 25 because it just shows they're in control, and it won't scare the horses either, right?
Yeah, because emergency or volatility begets volatility. But if you act like there's an emergency, well,
yeah, if they do 50, people will think there's something wrong,
yeah.
And that'll send a very nervous message to the market. That's not what they're trying to do, because what they also pointed out is that the stability in financial markets is also part of their mandate. It's not just unemployment and inflation. They need to make sure that the financial markets are working and stable. And to have one of the largest stock markets in the world move 12% in one session and 10% in the other, that doesn't feel like stable markets to me. I mean, that's not their remit. But the volatility in market, I mean, the VIX went to over 62 last night, Nadine, which is like, that's not a stable market.
Yeah,
you know
yeah.
what I mean?
And that's what I was going to say, is that
Yeah.
even though we have seen sort of July, August sell-offs before, that whipsaw that we were seeing. I mean, this time yesterday, when I was, shutting down the COB, it was, triggers being flagged in South Korea. Taiwan's market was falling out of bed.
Yeah,
Volatility index,
were being
circuit
impacted.
breakers, Nikkei futures. I mean, it's been pretty wild. So what are you telling us here, that we need to keep calm and carry on?
Yeah, there's a little bit of that keep calm and carry on, in that we do get at this time of year, July, August, we do get these sell-offs. They're not uncommon. This is just over the last sort of 10 or 15 years, we have seen some pretty significant sell-offs in this time of year, last for a couple of months, and then the markets recover, with one notable exception being the GFC, which just kept going and going and going. But volatility around this time of year. Now, there's all these arguments about people being on holidays and market activity being thin, and also it's reporting season. Reporting season is a little bit volatile. So if you get a softer reporting season and very thin volumes, you get a bit more volatility. We know that most of Europe's on summer holidays. We know a lot of traders were not at their desks on Monday, which is why the Nikkei and other Asian markets got hit so hard, because they were trying to find liquidity. So it's not unusual to have these kind of movements this time of year.
Okay, so putting that all into context, you mentioned that we still do have earnings going on in the United States.
Yeah.
So leading up to this, market meltdown, most of the results were coming in pretty well. There wasn't a lot of fear being expressed in the commentary coming from CEOs. Now, everybody will be very attuned now to anything that's talking about jobs, unemployment, any layoffs, and the consumer.
Yeah, and look, there's a number of examples of companies that have come in with guidance and outlooks that's less than the market. Even Audinate in the Aussie market, that's a global technology company. Their guidance was 50% below consensus. It was a big thing. We've seen Intel sell off very dramatically. So there's, it hasn't all been roses and chocolates in this reporting season. I think there's still vulnerability around. We've got things like Novo Nordisk, I think, reporting tonight or tomorrow night. So if they guide lower on GLP-1 drugs, for example, that's a very elevated stock. So there's still, I think, a lot of earnings risk just going through this result, just based on where valuations are. So you don't get these sell-offs in a cheap market. You get these sell-offs when PEs are elevated. So I still think there's risk. I think there's going to be continued volatility in markets. I mean, to have 10-15% moves in major markets tells you that the market's very finely balanced. There's lots of hot money around. We've seen big moves in things like crypto. So there's lots of risk on, risk off going. So I think people just need to sleep with one eye open for the next couple of weeks, Nadine, and just be cautious.
Any big opportunities that you're seeing yet in our market?
Not yet, I think, but valuations have become a little bit more attractive. Obviously, the market's off 5% in Australia so far this month. So, but I still think there's probably a little bit more downside in some of the names. We're seeing things like Domino's, IDP Education, some of these quality growth stocks that are having a bit of a downgrade cycle. They're looking really interesting to us at the moment. I still think the gold sector looks fantastic, notwithstanding costs are going up and capex is going up. The outlook for gold with falling rates looks really good. So I think there are some stock picking opportunities out there, but the market as a whole, it's probably not screaming value at it quite yet.
Got it. Martin Crabb, Shawn Partners, always good to have you in.
Thanks for having me.
As always, but especially on an RBA day. How about that? All right, let's get to... well, I think it's our stock of the day. It was Treasury Wine Estate. Sean Hickman, Market Matters, Mark Moreland, Team Invest. Let's take a listen.
Like the way they've evolved their business, obviously after it had its legs cut off when China closed the doors. They've evolved very well into the US, and I think as a business they've done a good job of that. I think the market got ahead of itself about how well China was going to let wine back in, and they built on 2 weeks of earnings. But I think going forward, we're long we like the stock and we think it's going to outperform.
Look, if you look at the numbers, its return on capital is only 5.6. We have a minimum of 10%, so it doesn't hit it. It doesn't pass our screening, so we would never look at it. If I look at it from a return point of view, it's still currently on a PE of 25.8. Its EPS growth rate average for the last 6 years has been negative 4.9, and sales have declined at 1% over that period. So it's pretty ordinary. Now, what Sean was saying is, well, they're positioning now to go better. Well, they may well, but from a price point of view, 25 PE is way too high for a company that's really in a turnaround situation, in our view.
So there you go. There's the verdict on TWE. You can listen to that in its entirety up on our website, ausbiz.com.au. Let's get across some of these market leaders. So this time yesterday, there were only two companies in positive territory, if you do recall. Well, what a turnaround today. And one of those companies that was the biggest losers yesterday was Deep Yellow. So we saw some bargain hunters, I dare say, move into the likes of Lovisa, Webjet up by 3%, Reliance Worldwide 3%, Paladin Energy close to 4% higher, and then Deep Yellow up by 4.76%. On the flip side of the page, some of those laggards, well, you heard Martin Crabb, CIO at Shaw Partners, talking about this, saying that Audinate has warned on FY25's outlook, although it does expect to return to growth in FY26, with this FY25 profit to fall marginally on FY24 and revenue to fall as well on FY24. The market's really downgraded it at like big ton, 37%, pretty close to it. Another growth stock, Pro Medicus, down by 6.7%, although if you listen to today's episode of The Call, you might find something out about where Mark Moreland would be happy to buy Pro Medicus if we continue to see some of these real down days. Emerald Resources is also off, saying that it will continue future developments with Maca. And Red 5 put out an investor presentation. It's at the Diggers and Dealers Conference in Kalgoorlie, which has been overshadowed by all of the news of the past few days. But yeah, Red 5, they're one of the worst performers, off by 5.5%, and Woodside Energy off by 4.4%. Very quick run through the small caps. Appen, after falling 14% yesterday, up by 20% today. Flipping the page to see what was lagging, and Atlantic Lithium. These are all sort of resources companies here. Atlantic Lithium down by 15.3%. So last night we were very mindful of that ISM services read. It did come in higher than expected, so that did calm some of the fears about the US recession. Tonight we get Eurozone growth in retail sales, expected to pull back modestly in June, although Westpac says increasingly outcomes are mixed by country. In the United States, we do get the trade balance. That's for June. The trade deficit is anticipated to narrow, reflecting broader underlying weakness in the consumption of goods. And speaking of consumption, we do get some big earnings out in the US, Airbnb, Uber, Wynn Resorts amongst them. But the one we'll have local flow through here is Caterpillar. Of course, Seven Group is the local distributor of Caterpillar, so we'll be keeping our eye on that closely. Tomorrow here, the New Zealand unemployment rate. We'll hear from RBA Assistant Governor Hunter, and a few earnings coming through, Light & Wonder and Arcadium Lithium. So we will still, of course, be digesting what's come from Michelle Bullock's media conference that has just wrapped up. Sounds like she's concerned about both sides of the equation going to hold for too long, or, letting that inflation genie, get out of the bottle once again, or I guess to a more significant degree. So the local market making up some of yesterday's losses, some, I say, not all. The equity index overall still down about 3.3% for the week, but nice to see a little bit of a rebound happening here locally. Although I will say, and still stick with me, Martin Crabb from Shaw Partner, my guest host here, saying sleep with one eye open. 7,680 for the S&P ASX 200. We look forward to seeing what's coming tonight. We'll get you across it all in the morning.